What do rising interest rates mean for the economy and, more importantly, your financial plan? Well, here to talk with me about this is Massey DeSantis from Desmo Wealth Advisors. Massey, welcome.
Hi, Bob, and hi, everyone. Thank you for having me.
Pleasure. We're eager to have you walk us through this question about rising interest rates and what they mean.
Yes, definitely. I wanted to write about this because obviously you read about it everywhere. And a lot of the things you read are pretty pessimistic about the effect of rising interest rates. And so I just wanted to clarify some of the basic principles about interest rates and with the article, and then offer some suggestions for what to do with your plans if you're concerned about certain risks. And the first lesson about interest rates is really to think about the interest rates as prices. So interest rates react to some fundamentals in the economy. They are not necessarily determining things, but they're more reacting to other things. That's important. It's like saying, the thermometer reading is going up, determines hot temperature. Obviously, that's not the case, the other way around. And it's the same with interest rates. What is driving interest rates up is more important than just the fact that they're going up. And so the first thing to notice, there is a force. Normally, one of the things we know about interest rates, that they tend to rise in economic expansion. So when we look at the data, interest rates are typically higher when things are better. So you shouldn't necessarily have a negative or a pessimistic view. And so we show a great chart in the article that shows really that, for example, a period between 2003 and 2006, we came out of a recession in the early 2000s, and then interest rates started rising and went from 1%, let's say in 5-year bonds, all the way to 5%. If you remember in 2005, 2006, you could get 5% in a savings account. So, what the interest rate did go up, but then if you look at stock returns and bond returns even, were both positive and above average. So the returns were pretty good in that period. So rising interest rates could be a good thing. And actually, normally it is a good thing for the economy. So we want that. So that's one effect that I think we should consider when talking about interest rates.
Right. So a lot of folks at the moment, Massey, and I know there's quite a bit that you wrote in your article about this topic, but just for the benefit of folks who may not be familiar, one of the principles of bonds is that when interest rates rise, the value of the bond may fall, and when interest rates and vice versa is true.
Yes, that's true. But one thing to think about is that there's so many different bonds of so many different types. So for example, like in that period I was describing, corporate bonds had relatively good returns. Why is that? Well, because even maybe interest rates are rising, but the spread that they typically paid because of the riskiness went down in that period. And so actually the interest rates on those bonds started to go down rather than up. So there's many different interest rates that don't move all at the same time. So that's one thing that I want to talk about. The other thing is, again, think about the drivers. It's true that the bonds are going down, but if the interest rates are going up, typically that dampens the bond returns, but that's one component of the return. Because especially, you're getting these coupon payments, right? So even if as interest rates are rising, and the value of that bond may be declining, the overall value of your investment could still be rising for that reason. And number two, especially if you reinvest that coupon payments into the same bond portfolio, now you're getting bonds at a lower price or at a higher yield. So over a period of time of rising interest rates, you could actually have decent returns in a bond portfolio. So don't just look at the one-time effect, the one-shot effect of interest rates on your bond portfolio. So that's the other thing to consider. And I think the biggest challenge right now is why people have a negative view about rising interest rates is because of what is the Fed going to do, right? If the Fed raises interest rates, is that bad? And I show a chart in the article which shows actually interest rates have already been going up, even before the Fed. So typically that's what you see. If the Fed signals that they may be increasing interest rates, you'll see interest rates are going to rise today, right? Markets are not going to wait for the Fed. So they'll factor in that rate hike. And that's what you want, because that will make it easier for the Fed to do it. when they're going to do it. So that's part of what we call credibility of the Fed. The Fed doesn't need to act if it's credible, and so they can help guide the economy. Now, the downside is that right now we have two challenges. One is a lot of spending, unprecedented spending, because we were coming out of a recession that was, a pretty drastic and different from anything we had experienced in the last century or so. And so that's one. Number two, big boost from monetary policy. The money supply increased rapidly in the last couple of years. So now I think there's a concern. Well, the Fed is doing everything right, but is it too late, or is it too little, too late? That's the concern. So that's one side of the risk, because if that's the case, that may dampen the whole story that I was talking about in expansions, and we are in expansion. Interest rates rise, and that's good for the economy. But there's some challenges that we'll have to face, and that's what the Fed is trying to do. So you have these two risks, and that's why you see a volatility in the markets, besides geopolitical risk that's going on at the same time. But I think from the Fed and the monetary policy and our own expansion, these are the two risks. You have a good side, which is rising interest rates because of the expansion, and then you have the negative side. Is the Fed, what they're doing, is that too little or too late, or is it right, just right? That's the two risks that we're measuring against, and that's why you see the volatility in the market. If one side prevails, then you'll see markets going down. If the other side prevails, and that's what creates this moment of uncertainty. That right now they're kind of equally weighted. Yeah. And so we'll see in the next few months, but this will be temporary. This uncertainty will be temporary. So you can expect volatility in the next few months or so. But then I think we'll have more clarity around inflation.
Yeah. So as you mentioned inflation and the notion that the Fed would be using interest rates to damp down the increase in inflation. Is that for many folks a big concern, or should it be?
Well, I mean, we hope, we have a strong central bank. In the last 30 years or so, the central bank has been really good at managing the money supply. So we have to have some trust in that. At the same time, obviously, there is a risk. And so how do you protect yourself against that risk, right? And so we talk about that in the article. And definitely, if that's a risk, one of the things you can do, at least in your fixed income portion of your portfolio, is to direct more of that fixed income towards inflation protected securities. And I mentioned TIPS. We've talked about in the previous article about I bonds. But the other thing that I was going to mention is there are other bond portfolios that are not necessarily government bonds that have inflation protection. So there are some providers that have real return munis, where they actually adjust for inflation. They give you a muni return. And then there is others that are on corporate, intermediate corporate bonds portfolios as well with inflation protection. And so those, consider those, so you'll get the same exposure that you have to munis if you want, corporate bonds, government bonds, but on top of that, you'll get inflation protection. So at least you'll get the rate of inflation on your portfolios.
So when you talk about what to do with your investment plan, besides those things, saving more was also on the laundry list of things to do on your checklist?
Definitely. I mean, and I think, you don't have to remind people, but, well, actually, maybe you do have to remind them. They know it. They just need a little bit of a nudge, because I think right now, if you have big plans, big ticket items and, vacation items, maybe just wait. It's hard to, if you had that plan, but sometimes it's always better in periods of high uncertainty to wait to make these type of irreversible decisions. They're pretty big. And so just wait it out. Similar, sometimes you have to take money out from investments to make those expenses. Well, you may want to wait, especially if markets are coming down, and then you're going to realize some losses that may not be ideal.
Yeah. You also recommend using a goals-based approach as part of your plan?
Yes, that's because if you build up your plan, your portfolio, starting from the goals, then you have a better clarity around risk management. Like if you know that money is dedicated to retirement, and you'll see the market is entering possibly a correction territory, then you say, well, it's okay, because I know that I won't need it for the next 20 years. On the other hand, if you see that you have something that you're saving towards for the next 5 years, because maybe you want a down payment on a home, you're going to be a little bit more careful there, and that will help you also save more towards that goal, right? So the goals and knowing where your money is going helps you with this. I call it risk management, and as an advisor, but really, is knowing where your money is going helps you make better decisions today.
Well, this is certainly a topic that's on everyone's mind at the moment. Anything we missed, or anything that bears reemphasizing?
Well, I think it's worth emphasizing that the reason why we are invested is because we are taking some of the risks in the hope of better returns in the long term. So always think about long term, and definitely not make rash decisions just reacting emotionally to what's going on in the markets.
Massi, as always, I want to thank you for sharing your knowledge and wisdom with our readers and our viewers. It's greatly appreciated.
Yeah, thank you.